So recall that equity is one of the balance sheet accounts. That is, equity is what's left over on the very far right side after we've taken all our assets and subtracted from them all our liabilities. And to increase an equity account, we credit it, or it's on the right side, and to decrease it, we debit it, or it's on the left side. So how do the expenses and revenues of a business affect that equity account? Remember that revenues will increase equity account, and expenses will decrease equity account. So they're going to work in counterfaction. Since we want the equity account to increase, or be credited, then revenues increasing is going to also be a credit. We want that to work in the same direction. Credits increase on the revenue side, which will ultimately increase on the equity side. If we have a decrease in revenues, it's called a debit for revenues, which is going to decrease the amount of ultimate money that we put into the equity account, or the equity side. The other side of that is expenses. Because a debit will decrease the equity account, increase in expenses, or credit in expenses, will decrease the equity account, because expenses decrease the equity account and revenues increase the equity account. On that same token, if we're debiting expenses, which is an increase of expenses, if we're debiting that, that is going to decrease the equity account. You see what I mean before when I said it maybe is best to forget about what you know about debit and credit, because it's really a new usage of the word here. They take on different meanings depending on what account you are talking about. But if you ensure to understand that relationship, that debiting an asset account increases it, and crediting an asset account decreases it, and debiting an equity or liability account decreases it, and crediting an equity or liability account increases it, that should give you the framework that you can work through these examples.